The largest IPO in history is not waiting for the rate environment to settle, and that asymmetry is the problem markets are now pricing. SpaceX filed its prospectus Wednesday, targeting a $1.75 trillion valuation, which would eclipse Saudi Aramco's 2019 record and slot the company among the 8 largest publicly traded firms in the United States overnight. The number itself is not what moved positioning. What moved positioning is the Nasdaq's new fast entry rule, which makes newly listed mega-cap companies eligible for index inclusion after just 15 trading sessions. That rule, activated May 1, means that every fund tracking the Nasdaq 100 will be mechanically required to purchase SpaceX shares within weeks of the June 12 debut, creating a wave of forced passive buying that analysts estimate in the tens of billions of dollars. The forcing function is the word that matters here. Passive flows do not require conviction, they require inclusion. Retail investors who had no plan to buy SpaceX will own it through their index ETFs before the summer ends. The company's $18.67 billion in 2025 revenue, 33% above the prior year, is anchored almost entirely in Starlink's 10.3 million subscribers, a subscriber base that doubled in 12 months. That growth rate is the justification for the $1.75 trillion ask. But the filing also disclosed a net loss of $4.3 billion in the first quarter alone, driven by the nascent AI unit which Musk merged into SpaceX earlier this year. Institutional holders are being asked to price a profitable satellite business at a premium that only makes sense if the AI data center ambition in orbit materializes. The capital flow pattern so far, BlackRock reportedly positioning between $5 and $10 billion in the offering, suggests large institutions are buying the satellite thesis and treating AI as a free option. Whether that framing survives the roadshow is what the June 4 marketing launch will test.
The same week SpaceX opened its books, a jury cleared the last legal obstacle standing between OpenAI and its own public offering, and the connection between those two events is not coincidence, it is sequencing. On Monday, jurors ruled against Elon Musk in his $150 billion lawsuit challenging OpenAI's conversion from nonprofit to for-profit, finding the case was filed too late on procedural grounds. By Wednesday, according to the Financial Times, OpenAI had engaged Goldman Sachs and Morgan Stanley with a confidential filing that could land with regulators as soon as this Friday, targeting a September debut. The private market shares on Forge Markets are already trading at $735, up 46% in 3 months, reflecting investor anticipation of a public valuation the secondary market currently places near $906 billion. The mechanism deepening from Chapter 1 is this. SpaceX's IPO does not stand alone as an event. It functions as the demand signal that makes the OpenAI offering viable at scale. SpaceX's filing showed Anthropic paying $15 billion annually to access SpaceX data centers. That single line in the prospectus reframes OpenAI's forthcoming IPO from a pure software story into an infrastructure dependency story. OpenAI's compute costs are now publicly legible, and they run through Musk's own company. Musk said Monday he will appeal the verdict, and his XAI unit remains a direct OpenAI competitor inside SpaceX's own balance sheet. The capital flow consequence is that institutional positioning ahead of 2 simultaneous trillion-dollar listings is concentrating in a small set of underwriting banks, Goldman Sachs, Morgan Stanley, JP Morgan, whose fee potential from both deals combined approaches $1 billion. Retail access through Schwab, Fidelity, and Robinhood on the SpaceX side broadens the demand base but also introduces price volatility from less informed holders. What neither filing answers is how 2 companies competing for the same AI infrastructure market price against each other in the same index, and that unresolved question is exactly where the rate environment cuts in.
The Fed's April minutes, released Wednesday, delivered the hawkish signal markets had been testing since the Iran war began in late February. A majority of Federal Open Market Committee participants indicated that some degree of policy tightening would likely become appropriate if inflation continued to run persistently above the 2% target. The vote to hold rates at 3.5 to 3.75% registered 4 formal dissents, the most at a single meeting since 1992, with 3 of those 4 objecting not to the hold itself, but to the easing bias language that signals eventual cuts. Kevin Warsh, sworn in as Fed chair after Jerome Powell's term expired May 15th, will chair his first meeting on June 16th and 17th, days after SpaceX's planned June 12th listing. The conditional branching from the IPO story is now explicit. A Warsh-led hike in July, which strategist Edgo Denny calls likely, will raise the discount rate applied to both SpaceX and OpenAI's forward earnings at the exact moment retail investors absorb forced index exposure. The Iran war's role in this chain is structural, not incidental. Total PCE inflation is running at an estimated 3.5%, core PCE at 3.2%, and the survey of professional forecasters projects headline CPI nearly doubling to 6% in the second quarter of 2026. Oil at Brent $105 before Wednesday's 5.75% drop on Trump's final stages comment shows how fragile the inflation relief is. The Strait of Hormuz remains partially closed, and the UN has warned of a severe global food price crisis from fertilizer disruption. For Canadian investors, the transmission is direct. Markets are now pricing better than even odds of a Federal Reserve rate hike, which pulls Canadian fixed income yields higher and compresses the valuation premium on rate-sensitive dividend stocks that anchor most TFSA portfolios. The leaning tilts toward the hike scenario materializing because the Iran ceasefire of April 8th has not reopened the strait, and one Trump comment does not resolve the supply disruption that is driving the inflation the Fed is reacting to. The verification benchmark is the June 16th FOMC meeting. If war signals a July hike explicitly and Brent oil holds above $100, the IPO pricing window for both SpaceX and OpenAI narrows sharply. If the Iran deal closes before the roadshow ends June 11 and oil falls below 90, the easing scenario reopens, and the forced Nasdaq buying lands into a falling rate environment that re-rates both listings higher. The number to watch tomorrow is the 10-year U.S. Treasury yield. It pulled back 9 basis points to 4.58% on Wednesday's Iran news, but it touched its highest level since 2007 the day before. A closeback above 4.67 would signal that the peace optimism is being unwound faster than the IPO calendar can adjust. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.